We're beginning Chapter 1 of Delay, Deny, Defend by J.N. Feynman. How Insurance Works. The world is an uncertain place. Bad things happen to good people, and to bad people too. Houses burn down, cars crash, hurricanes devastate the coastline, pedestrians slip on ice-covered sidewalks, and, in other ways actual and metaphorical, lightning strikes. The bad things are usually unexpected, in part because people often assume, or at least hope, that bad things only happen to other people, not to them. In the language of insurance, the bad things that can happen, and sometimes the people or things they can happen to, are known as risks. The universally understood element of risks are uncertainty and loss. The risk might or might not come to pass, but if it does, someone will suffer a financial loss. The purpose of insurance is to ameliorate the financial consequences of risk by transferring the risk from an individual to a group and sharing the cost of the risks that come to pass among the members of the group. In this way, every insurance company essentially operates on the same premises as the oldest extant insurance company in the United States, the Philadelphia Contributanship for the insurance of houses from loss by fire. The contributionship was founded in 1752 by a group of volunteer firefighters led by Benjamin Franklin. The risk of destruction by fire in colonial America was immense. So Franklin did, and his colleagues adopted the model of the Amicable Contributionship of London, founded in 1696, in which subscribing homeowners contributed specific amounts to be paid to those unfortunate ones whose houses burned. The risk of fire loss was transferred from the individual homeowner to the contributionship and shared among its members by their financial contributions. The contributionship illustrates the concept of insurance in operation. The person is willing to exchange a small, certain loss, the payment of a premium, to avoid the potential of an uncertain but potentially larger loss, the cost of rebuilding a house. On the other end of the transaction is the insurance company, which is willing to accept the risk of large, uncertain loss in the exchange for the small, certain payment, because it pools many such payments. This simple description encapsulates every insurance transaction, whether it is the everyday purchase of a homeowner's insurance policy or the acquisition of multi-billion-dollar commercial policies by Larry Silverstein, who, with exquisitely bad timing, acquired a 99-year lease on the World Trade Center in July 2001. This process, by which the company assesses risks and accepts their transfer from policyholders, begins with the accumulation of information about the incidence of losses. Before it issues auto policies, for example, a company wants to know, for a given year, using 2007 figure, that 515 out of 10,000 drivers will have claims for property damage. There will be 21 fatalities in motor vehicle accidents for every 1,000 licensed drivers at driver age 21 through 24, is almost 3 times as likely to be involved in a fatal crash while legally intoxicated than a driver 55 to 64 years old. The average collision repair for all cars costs $3,131. The average collision repair on a Ford Focus costs 17% more than on a Honda Civic Hybrid, and so on. Actuaries sift and process this mass of statistical data and evaluate and define what kinds of risks the company might insure and what rates. Drivers are classified and rated separately by age, gender, marital status, and driving training experience. Once the type of risks that will be insured are defined, underwriters establish the kinds of insurance policies that will be offered and the limitations on those policies, what will be covered, for what amounts, and to whom the policies will be sold. Then the marketers and agents go to work, advertising and selling the product, with the underwriters evaluating applications as they come in to ensure that they fit within the established guidelines. We're going to back it up to Mr. Larry Silverstein and the footnote I missed. The attack on 9/11 generated a dispute between Silverstein and his insurers. Was there a single occurrence of a coordinated attack on both towers, which would have limited his recovery to $3.5 billion, or were there two occurrences of one plane striking each tower, in which case the payment would have been $3.5 billion per occurrence, or $7 billion. After litigation involving armies of lawyers, courts came to different results under the language of different policies. Moving on. As is typical the case with corporate America, the economics that make this system work are simple in concept, but rococo in application. To remain solvent and to turn a profit, the insurance company wants to pay out less than it takes in. It takes in premium dollars from policyholders. It pays out on claims. The ratio between these two figures is known as the pure loss ratio. The property/casualty industry as a whole in 2007 earned $451 billion on premiums and paid out $251 billion in claims. For a loss ratio of 56. In other words, the insurance industry paid out to policyholders and tort victims 56 cents of every dollar the policyholders paid in. The industry's pure loss ratio has been improving over time, if improving is measured from the company's perspective. The loss ratio in 1987 was 67, and in 1997 it was 61, which means that it has paid out a nickel less for every premium dollar compared to 10 years ago, and a dime less compared to 20 years ago. But paying out claims is not costless. Adjusters' salaries have to be paid, computers have to be bought, and offices have to be rented. All of those costs are considered loss adjustment expenses, LAE, or expenses that are directly related to paying claims. These costs are added to pure losses, the direct payouts to get obviously the loss and loss adjustment expense ratio, the property/casualty industry loss adjustment expense or expenses that are directly related to paying claims. These costs are added to pure losses, the direct payouts, to get obviously the loss and loss adjustments expense ratio. For the property/casualty industry, loss adjustment expense in 2007 was $54 billion, and for a loss adjustment expense ratio of 67. Then add to this all the other expenses the company has: salaries and expenses of the underwriting department, commissions to agents, the cost of the call center and Gecko ads, and overheard such as the IV and overhead such as the IT department and the executive dining room to achieve the combined ratio. In 2007, these other expenses were $121 billion, yielding a combined ratio of 95. A combined ratio of less than 100 is good for the company. Considering all expenses, the company is taking more than it is paying out. But even a combined ratio of over 100 is not necessarily bad, because the company is taking in something else: investment income. The company pools policyholders' premiums to pay losses and expenses. But it does not simply hold the money until it needs to pay it out. It invests the money in the meantime, which is why insurance companies have been described as investment companies that raise the money for the investments by selling insurance. The time lag between taking in premiums and paying out claims, the float, and the income earned in that time is a major source of profit. In 2007, industry investment profits totaled $58 billion. As Warren Buffett, whose Berkshire Hathaway owns Geico and other insurance companies, has said, float is the great thing about the insurance business, because it is money we hold that is not ours, but which we get to invest. A company that can take advantage of float and also produce an underwriting profit, a combined ratio less than 100, has the best of both worlds. Buffett trumpeted his folksy 2009 letter to shareholders that we were paid $2.8 billion to hold our float in 2008. Charlie Munger, Buffett's longtime partner, and I've found this enjoyable. In this way, an insurance company is like a bank, which takes in customers' money as deposits and lends that money out at a higher interest rate than it pays on depositors' accounts. The difference between the rate on loans and the rate on deposits, less the bank's expenses, are a bank's profit. Insurance companies have an advantage over banks, though because their loss ratio can be less than 100. The bank depositor always gets back 100% of the amount deposited plus interest. The insurance company, with a pure loss ratio of 50, is only paying its customers 50 cents on the dollar, even with higher expenses than the bank. With a combined ratio less than 100, the insurance company is ahead of the game even before its investments earnings. At some point, one of the unfortunate events that constitute the risks that were transferred from the insured to the company will occur. A car will crash, a house will burn, and an insured will file a claim. At that point, the fundamental truth about the claim process should come to play. When a loss occurs that is within the coverage of the insurance policy, the policyholder has already paid for the loss. The risk has been defined, priced, transferred from the insured to the insurance company, and shared by the company among the policyholders and investors. So all that is legitimately left to be done is to pay the claim. From the policyholder's point of view, the covered event should now be risk-free. That is, free of risk that the company will fail to pay what it owes. The actuary's job is to evaluate risk characteristics. The underwriter's job is to evaluate potential insureds. And the executive's job is to manage the whole process. But the claim adjuster's only job is to decide if a loss falls within the policy, determine the extent of the loss, and pay the claim. Under life insurance policies, keeping the company's promise and paying what is owed usually is easy. The family sends in a death certificate, so the adjuster knows the insured is dead. The adjuster knows how much to pay from the face amount of the policy. All that is left to do is cut the check. Only in the most unusual cases is anything else involved. Rare are situations like that of Helen Goulet and Olga Rudderschmidt, the hit-and-run grannies. Two elderly ladies took out dozens of life insurance policies worth a total of $2.8 million on homeless men, Kenneth McDavid and Paul Vados, and then murdered them in staged hit-and-run accidents to collect the insurance. The claim process in property / casualty policies, on the other hand, can be more complicated. The definition of coverage under the policy can be Byzantine. A homeowner's policy covers all risks of sudden physical loss to the property. An exception excludes coverage for damage caused by water. An exception to the exception includes coverage for water damage caused by sewers backing up. The fact that trigger coverage can be unclear. How much of the damage to a house struck by Hurricane Katrina was due to wind, covered, and how much to water, not covered? If an event is covered, the amount due may not be fixed. Uninsured motorist coverage pays for non-economic damages such as pain and suffering, but there is no simple monetary measure of how much suffering a claimant has endured. No matter how complex in an individual case, a set of simple rules of the road of claim adjusting control the process. These standards are subscribed to by every insurance. Allstate's goal remains the same: to investigate, evaluate, promptly resolve each claim based on its merits, according to spokesman Michael Simenas, even when being sued by their policyholders. Insurance companies acknowledge the rules. In a California case arising out of the Northridge earthquake of 1994, State Farm acknowledged its claim obligation is to operate its claim service in a manner so as to ensure that the insureds receive all that they are owed consistent with the facts of the loss and language contained in its policies. The National Association of Insurance Commissioners, NAIC, has promulgated minimum legally enforceable standards in its Model Unfair Claims Settlement Practices Act, a version of which is in effect in nearly every state. And judicial decisions in every state adopt and amplify the standards. The most basic rule is that in adjusting a claim, the company must not put its own interests above the interests of the policyholder. When a policyholder files a claim, she is invoking the promise of the insurance company to accept the risk and to provide security in the event of loss. That promise means that the company will not try to increase its own profit at the expense of the policyholder, or to take advantage of the insured precisely at the moment when she is most vulnerable. Giving adequate consideration to the policyholder's interests means that the company must act promptly and must fully pay all legitimate claims. The National Association of Insurance Commissioners Model Act requires a company to promptly and fairly settle claims in which liability is reasonably clear, to make its decisions about coverage within a reasonable time, to give reasons if it denies a claim, to maintain standards for investigating claims, and to be objective in investigating claims. It explicitly prohibits companies from making lowball settlement offers that force policyholders or accident victims to sue to recover the amounts they are entitled to. Industry standards and the law require companies to interpret provisions of the policy that establish coverage broadly and to interpret provisions that exclude coverage narrowly. In the case of uncertainty, all doubts are resolved in favor of the policyholder and against the company, which wrote the policy and had the ability to draft in a way that removed doubt. The company's obligation is even greater than being an independent adjudicator. The company has an affirmative obligation to help the insured with its claim. Insurance companies tout this role of aiding their policyholders. The State Farm website quotes Carmen Drake, an auto claims adjuster, who says, "I approach each customer's claim as if it were my own. That is, of course, what a good neighbor should do. The company must tell the policyholder about all the benefits and conditions of the policies. She should not have to hunt through the policy to find out what she is covered for and what pieces of paper she has to file to establish her claim within what time periods." A fair claims process is central to the insurance relationship because the policyholder is not just buying a run-of-the-mill product or entering into an ordinary contract. She is obtaining security against an uncertain world. The Utah Supreme Court summed it up in the course of an opinion castigating State Farm for denying policyholders the benefits to which they were entitled. Insureds buy financial protection and peace of mind against fortuitous losses. They pay the requisite premiums and put their faith and trust in the insurers to pay policy benefits promptly and fairly when the insured event occurs. When the insured event occurs, good faith and fair dealing is their expectation. It is the very essence of the insurer-insured relationship. The insurance company's promise of security has real value, and people often understate its value. In a classic commentary in 1849, insurance entrepreneur D.R. Jacques wrote with respect to premiums, "The afflicted finds his money spent to some purpose, and only the fortunate part with it for nothing. But that is wrong. The fortunate, those whose risk never come to pass, and therefore never collect a penny from their insurance companies, spent their money for the purpose of security and peace of mind." Insurance companies market this feeling as of security as much as they market individual policies. You're in good hands with Allstate. Nationwide is on your side. Like a good neighbor, State Farm is there. At Liberty Mutual, it's responsibility. A good neighbor is not a stickler for legal technicalities. A good neighbor picks up your newspaper while you are on vacation and doesn't complain if you don't return the cup of sugar you borrowed. More to the point, a good neighbor shovels the snow off your sidewalk if you are elderly and brings you soup when you are sick. Like good neighbors, your insurance company and you are bound by ties that law and profits cannot define. The insurance policy is a detailed contract, not just a vague promise of security, but it is a contract of a distinctive kind. Insurance lawyers sometimes speak of the four corners rule. The scope of coverage and the company's responsibilities are defined within four corners of the paper on which the policy is printed. But courts have recognized that the relationship of these parties involved in an insurance contract is not fully captured by the printed words because it arises in a context and contains expectations created by advertisements, the sales pitch of agents, and common understandings of the role of insurance in providing security. Indeed, some courts disregard the express terms of the policy when they conflict with the reasonable expectations of the policyholder. In a famous case articulating this principle, the Iowa Supreme Court rejected the policy definition of the burglary of a store as requiring visible marks of forced entry on an exterior door, preferring instead an understanding held by the reasonable policyholder that burglary meant anything other than an inside job. The insurance contract is also different from most ordinary contracts because it requires sequential performance. In a typical contract, if one party doesn't perform, the other party can produce a substitute performance and sue for any added cost. If a homeowner hires a contractor to renovate his house and the contractor fails to show, the homeowner can refuse to pay, hire another contractor, and if he pays the second a higher price, sue the first contractor for the extra. But if the homeowner has a fire and his insurance company fails to pay the claim, it's too late for the homeowner to buy alternate insurance. The best the homeowner can hope for is to sue the company for the coverage that should have been paid. But even that is not an effective remedy. The lawsuit does not give the homeowner the money needed to rebuild until the litigation is concluded, perhaps years later, during which time the homeowner has lost the security and peace of mind for which he contracted. Accordingly, courts hold insurance companies to higher standards and subject them to special remedies if they fail to honor their promises. The promise of security extends beyond the relationship between an insurance company and an individual policyholder. For a long time, insurance in America was a community project, starting with the Philadelphia Contributorship, the original deed of settlement, creating the contributorship still on display at its offices in Philadelphia, is a 44-foot-long parchment scroll containing the signatures and property descriptions of the original 1,774 subscribers, starting with Pennsylvania Lieutenant Governor James Hamilton and the first private subscriber, Benjamin Franklin. Benjamin, shortly after Wisconsin received statehood in 1848, Several local insurance companies were formed to provide security for small town residents, just like the contributorship, and to promote development of individual towns. Germantown Mutual City of Waka- Waukesha, Mutual Cedarburg, Mutual Lakeland, Mutual and Minome Mutual. Various lumbermen's insurance companies came several generations later. The Indiana Lumbermen's Mutual Insurance Company was founded in 1895 by the Indiana Retail Lumber Dealers Association to provide fire insurance to its members at reasonable rates. Eastern Lumber Yard owners formed the Pennsylvania Lumbermen's Mutual Fire Insurance Company the same year for the same purposes. Lumbermen's Mutual Casualty Company was organized in 1912 on behalf of lumber companies to provide the newly mandated workers' compensation insurance and to keep rates low by promoting safer workplaces. Its first manager was James S. Kemper, who would later give his name to the Kemper Insurance Companies, of which Lumbermen's became a part. Because these companies were formed by businesses and individuals to share losses, they were keenly aware of their responsibility to pay claims. Hartford Fire Insurance Company was founded by a group of Hartford, Connecticut merchants in 1810. When fire posed a major threat to homes and businesses, after the Great New York Fire of 1835 destroyed hundreds of downtown buildings, including the New York Stock Exchange, 23 of 26 insurance companies in the city went bankrupt. Hartford's president, Eliphaz Terry, met his responsibility by driving a horse-drawn sleigh from Hartford to New York to personally pay policyholders' claims. Even today, the Doctor Company Insurance Group promotes itself as founded by doctors for doctors. With some 43,000 physician members, the company writes $700 million of premiums each year. Beyond its primary function of providing liability insurance, it rewards participation with its tribute plan that accrues funds based on a member's premiums and pays benefits on retirement, disability, or death. The company also promotes the collective interests of its members by lobbying for proposals to limit malpractice liability and working to promote electronic medical records. What is striking about all these efforts is that they are collective activities among groups of like-minded people and firms for their mutual benefit. Thus the origins of the term mutual insurance. Thus the origins of the term mutual insurance company. They are not transactions between a self-interested insured and a distant corporate entity. They are rather joint enterprises among Philadelphia homeowners, Waukesha residents, Indiana lumber dealers, or practicing physicians. In that respect, they share origins and purposes with traditional savings and loan societies. Think of the Bailey Building and Loan Society from It's a Wonderful Life, and not the SNL debacle of the 1980s. Landmannschaften and other immigrant aid groups and fraternal organizations that provide financial support for their members. In these entities, participation in insurance is a social activity that involves protecting oneself against calamity and a social responsibility as a member of the community to contribute for the benefit of fellows who might suffer a loss. Today, of course, most insurance is purchased through large companies rather than local organizations of covenantures for collective activities conducted on such a large scale. The company is the necessary vehicle. Thousands or millions of insureds are involved, so a bureaucratic apparatus and the incentives of the executive bonuses and shareholder profits are necessary to fund and motivate the enterprise. The core of the activity remains the same, however, collective action of all against the possibility of loss by some. The company acts as a fiduciary for the premiums pooled by all insureds and other like-minded people. The company profits from the transaction that is necessary to motivate it to act at all. But it owes the insured a duty to act to protect the insured's security. More broadly, insurance provides a social safety net for individuals and businesses, particularly for the middle class. Most Americans are only a car accident, a fire in the home, a lawsuit, or an injury away from the wealth, the comfort, and the lifestyle accumulated over a lifetime of work wiped out. Insurance does not remove all of the consequences of a catastrophic loss, but it can make it something other than a catastrophe. Amen to that.